Rivian Automotive Inc. closed its last trading session on Friday, May 22, 2026 at exactly $14.22 per share, marking a marginal intraday gain of 0.49% as broader market sentiment leaned into risk-on assets. This minor positive tick occurred during a week where trading volume showed a slight drop compared to its typical 29 million share average, pointing to a tense, expectant quiet among institutional investors. Everyone is staring at the immediate order book, trying to gauge if this level can hold. The immediate reaction to seeing a stable price in the mid-14s is to assume the electric vehicle market has finally digested the worst of its supply pressures and that the brand is coasting safely towards its next big product cycle. But if you peer underneath the immediate ticker tape, you find a massive structural shift that most retail traders are completely missing. The true story right now isn't about vehicle metal being bent in Illinois or physical delivery counts. It is the massive multi-billion-dollar joint venture with Volkswagen that is quietly altering how the company is valued by large institutions. Wall Street isn't looking at this as just a truck company anymore. They are starting to price it as a specialized automotive operating system developer. This creates an immediate discrepancy between what the average investor sees on their daily tracking screens and what the big money is positioning for over the next 12 months. When people talk about the electric vehicle sector, the prevailing expectation is that smaller, pure-play manufacturers are structurally trapped in a permanent capital destruction phase, destined to be crushed by legacy giants or dominant players. The common belief is that unless a company can instantly match the hyperscaled production volumes of something like a massive Tesla stock or a global conglomerate, its individual brokerage valuation will eventually decay to zero. People look at the historical cash burn rates, see a net loss of several $100 million per quarter, and assume the clock is ticking loudly towards liquidation. That is the consensus narrative you see splashed across standard financial media, and it drives a lot of the short interest and retail panic that triggers sudden daily swings. However, the reality of the situation challenges this surface-level view. While the bears focus entirely on the physical capital expenditures, the smart money using advanced online investment frameworks is looking at asset flexibility. The organization still retains a massive $4.8 billion liquidity buffer in cash and short-term holdings, a current ratio well above 2, and a multi-billion-dollar tech integration stream funded directly by external European capital. The expectation is an early-stage car manufacturer running out of runway. The reality is an insulated tech incubator with enough cash to complete its entire mid-size product design cycle without needing to dilute shareholders through predatory emergency stock offerings. This friction between public perception and institutional positioning is precisely what makes the current trading volume so fascinating to tear apart. If you monitor recent stock movement through a professional interactive broker's trading setup, you will notice that the daily swings have compressed into a tight coiled range between $13 and $15. This compression usually happens right before a massive structural breakout or a steep breakdown. Institutional activity has quietly shifted from outright selling to selective accumulation, especially after the recent first quarter earnings data dropped. In that report, the company actually beat top-line expectations, bringing in $1.38 billion in revenue and showcasing a narrower loss per share than the consensus model anticipated. Yet the initial emotional reaction from the broader trading public was to dump the shares, causing a brief after-hours drop before cooler heads prevailed. Why did that drop happen? Because the market is still conditioned to punish any company that isn't instantly generating positive free cash flow. They saw a negative free cash flow figure of over $1 billion for the quarter and hit the sell button, ignoring the fact that this capital wasn't lost in a void. It was aggressively funneled into modifying the tooling lines at the Normal, Illinois production plant to prepare for the mid-size platform rollout. Sector momentum has also been heavily influenced by regulatory tailwinds and shifting domestic policy, which directly affects how retail investors manage their portfolios on apps like the Robinhood app or via high-end services like Fidelity Wealth Management. Macroeconomic pressures, particularly persistent interest rate environments and volatile battery component pricing, have acted as a heavy lid on the entire automotive tech sector. When borrowing costs remain elevated, individual consumers hesitate to take on $60,000 vehicle loans, which naturally dampens the near-term delivery forecasts for premium consumer trucks. This is why the stock pulled back from its April highs in the mid-16s down to its current base. But notice how it refused to break below its key support levels near $12. Every time the price dips into that territory, automated buying programs from sophisticated self-investing accounts and intelligent portfolio systems kick in to absorb the selling pressure. The market is beginning to realize that the company's valuation floor is heavily supported by its structural technology assets, including a massive multi-billion-dollar stake in advanced robotic software and an integrated proprietary electrical architecture that other global automakers are literally paying billions of dollars to license. To understand how the company reached this critical inflection point, we have to look at its underlying core business model and how it contrasts with the traditional automotive landscape. Founded in 2009 by an engineer looking to rebuild transportation from the ground up, the firm spent over a decade in stealth mode developing a highly adaptable modular platform. This setup integrates the electric motors, battery pack, suspension, and thermal management systems into a single compact unit that sits beneath the cabin. This approach allows them to swap out different body styles without having to redesign the expensive structural powertrain components from scratch. Their primary revenue generation stems from two distinct consumer models, a premium utility truck and a full-size lifestyle sport utility vehicle, alongside a highly lucrative commercial fleet business that produces custom electric delivery vans. In fact, a massive global e-commerce giant holds an 18% stake in the firm and has a standing long-term order for 100,000 of these delivery vans, providing a predictable, recession-resistant commercial revenue baseline that ordinary consumer-facing electric vehicle startups simply do not possess. Comment below how many shares of Rivian you currently hold, or if you are completely staying away from the electric vehicle sector this quarter. Looking back at past performance and older financial reports, the company's initial public offering in late 2021 was one of the most visible examples of market euphoria in modern financial history. Fresh off the hype of early vehicle reveals, the stock debuted at $78 a share and immediately rocketed past $100, briefly valuing a company with almost zero commercial revenue at over $100 billion. That historical peak was built entirely on wild speculative expectations that completely ignored the harsh reality of global manufacturing logistics. What followed was a brutal, multi-year reality check. The company ran headfirst into severe semiconductor shortages, soaring lithium prices, and the immense operational friction of trying to scale up an automotive production line from zero. Older earnings reports from 2023 and 2024 showcased massive capital expenditures and deep operating losses that steadily dragged the equity value down by over 80% from its all-time highs. This painful downward trajectory forced management to radically restructure their operations, leading to aggressive cost-cutting measures, corporate layoffs, and a complete optimization of their manufacturing facility to strip out unnecessary production expenses. This brings us to the modern era of the business, where the entire investment thesis hinges on an aggressive transition from low-volume premium vehicles to a high-volume mass-market strategy. The upcoming midsize platform, featuring a smaller vehicle lineup slated to begin customer handovers in the coming months, is the weapon designed to achieve this scale. Management recently opened the online customization portal for reservation holders, allowing people to select interior options, wheel configurations, and paint upgrades for a vehicle positioned to start around $58,000. This pricing strategy places their new premium offering in direct competition with dominant existing mid-size utility options on the market. For investors tracking this through a Robinhood stock trading account or planning long-term asset allocations via Fidelity IRAs, this product launch represents the ultimate test of consumer brand strength. If the company can successfully pull demand forward and execute the manufacturing ramp without hitting unexpected factory bottlenecks, it will completely flip the script on its gross margin profile, which has historically been weighed down by underutilized plant capacity. When you evaluate the future outlook for this equity, the trajectory splits into two distinct, highly volatile paths based on the tension between market expectations and operational reality. The bullish scenario relies entirely on the successful execution of the mid-sized vehicle rollout, alongside the continuous inflow of capital from the Volkswagen tech partnership. If the company can hit its production targets at its central assembly plant, gross margins are projected to turn positive by the back half of this fiscal year, an achievement that would instantly trigger a massive wave of institutional upgrades across major investing sites. Furthermore, as software-driven revenue from advanced driver assistance systems and custom commercial fleet management tools scales up, the business can begin commanding higher technology firm multiples rather than lower legacy automotive manufacturing valuation metrics. Traders utilizing sophisticated tools on the Interactive Brokers platform are watching these structural markers closely, knowing that even a minor acceleration in delivery guidance could force short sellers to rapidly cover their positions, sparking a violent upward reassessment of the stock price. Conversely, the bearish scenario cannot be ignored, as the risks associated with scaling an automotive brand are notoriously high. If the domestic consumer continues to pull back on discretionary high-ticket purchases due to prolonged macroeconomic tightening, or if the company encounters unexpected software glitches in its new electrical architecture joint venture, the capital burn could easily widen. A prolonged delay in reaching positive gross margins would force the company to rely more heavily on its credit lines, driving up total debt, which currently sits around $6.5 billion. If you are analyzing this asset through a long lens on web-based financial setups like the SoFi trading platform or checking Fidelity mutual funds for institutional exposure, you must recognize that the safety margin is entirely tied to that $4.8 billion cash cushion. Any signs that this cash pile is depleting faster than the production line can scale will immediately renew downward pressure on the equity, potentially dragging it back towards its historical 52-week lows.
Ultimately, the central insight to take away from this deeper structural look at the company is that the market is currently pricing it based on historical trauma rather than its forward-looking financial evolution. The old expectation was a highly speculative, cash-burning vehicle company that overpromised and underdelivered during the post-pandemic supply chain crisis. The current reality is a strictly disciplined, capital-backed automotive technology provider that is systematically lowering its production costs while leveraging its intellectual property to secure multi-billion-dollar corporate partnerships. The stock's current stabilization in the low 14s represents a delicate truce between the retail traders who are fearful of near-term losses and the institutional funds that are quietly calculating the long-term value of the company's commercial contracts, its advanced robotics exposure, and its imminent mass-market vehicle rollout. Whether you are managing an individual brokerage account, trading digital assets via Robinhood Crypto, or reviewing automated allocations inside a SoFi robo-advisor setup, understanding this core disconnect is exactly how you stay ahead of the broader market narrative. As the delivery trucks leave the line and the customer customization data roll in over the coming weeks, the tension between what the public expects and what the financial reality delivers will inevitably resolve, and that resolution is going to dictate the next major multi-year trend for this stock. Disclaimer, this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Unshare with your friends. Bell. Subscribe.